Not all income is created equal. Two people can make the same amount of money, but one ends up paying twice the taxes while the other one gets rich quietly. That's the difference between earned income and capital gains. One is taxed like labor, the other is rewarded like ownership. If you've ever wondered why founders, real estate moguls, and investors build wealth so much faster, well, this is why. While most people work for an income, they build or buy assets that grow in value. So in this video, we're breaking down what capital gains actually are, how they differ from wages, how the tax code treats them, and why the wealthiest people in the world design their entire life around generating more of them. Welcome to Alux. So, the IRS doesn't treat all income the same, and neither should you, okay? The way you make money affects how much you keep. There are three main types of income in the US tax code: earned income, portfolio income, and passive income. And each is taxed differently, and that difference is not small. Earned income from wages, salaries, freelance work is taxed the most. In 2024, federal income tax rates range from 10% to 37% depending on your bracket, plus a flat 15.3% in payroll taxes for Social Security and Medicare if you're self-employed. Then there's capital gains from selling stocks, real estate, or assets held longer than a year. That's taxed at 0%, 15%, or 20% depending on your income level, and they avoid payroll taxes entirely. Then there's qualified dividends. Those are taxed like long-term capital gains, often at just 15%, sometimes at 0%. Then there's passive income from real estate or LP investments that may also benefit from depreciation and other tax shelters. So the result? A high-earning employee can pay 40 to 50% in taxes, while a private equity investor might pay under 20%. That is why, according to the IRS, the top 1% of earners receive more than half their income from capital gains, dividends, and business income, not from jobs. So let's break down what this means in practice, okay? So imagine two people each make $200,000 in a year. Person A is a high-paid employee, a doctor or lawyer. That income is taxed as earned income. They'll pay $45,000 in federal income tax, approximately 24 to 32% effective rate. $15,300 in payroll taxes if self-employed or split with employer, and the total would be about $60,000 in taxes. So their net income is about $140,000, not $200,000. Person B earns $200,000 by selling shares of stock held for longer than a year. That's long-term capital gains. So they'll pay $30,000 if they fall under the 15% capital gains bracket. $0 in payroll taxes for a total of $30,000 in taxes. Net income, $170,000. So that's a $30,000 difference for the same amount of income, just because of how it was earned. And it doesn't stop there, okay? The wealthy often structure their income to fall under capital gains by taking founder shares or equity in lieu of a salary, using the buy, borrow, die strategy to avoid realizing gains, and leveraging qualified small business stock or QSBS exemptions for up to $10 million in tax-free gains. In contrast, earned income has no such flexibility. You show up, you work, you pay full price before you even touch the money. Actually, in a 2011 interview, Warren Buffett revealed he paid a 17.4% effective tax rate on $62 million of income, while his staff paid between 33 and 41%. Why? Well, because Buffett's income came almost entirely from capital gains and dividends. He doesn't take a salary, he owns equity. And that is what most tech startup founders do too. They take minimal salaries and focus on building value in equity. When that equity is sold, it's taxed at favorable capital gains rates, and sometimes not at all under QSBS rules. Even on a smaller scale, a freelance copywriter making $100K will pay 30 to 40% in taxes. But someone who builds a content website, holds it for 2 years, then sells it for $100K, might only pay 15% and skip self-employment tax entirely. If you don't understand how your money is categorized, you will always be the one working harder and paying more. And inside the Alux app, we walk you through the ins and outs of not only building your wealth, but maintaining it, okay? Because, it's relatively simple to get rich, but staying rich requires a lot more savviness. If you want to start taking your wealth journey more seriously, download the Alux app and get access to thousands of lessons, plus expert-led courses on dedicated topics like private equity and personal branding. Even better, if you download the app and then scan this QR code, you'll get 25% off your annual membership. I'll see you on the inside. In the meantime, let's take a closer look at how capital gains actually work. So, capital gains are not income from effort, okay? They are income from growth, specifically the increase in value of an asset over time. And the tax system treats that kind of growth very differently. When you buy something like stocks, real estate, or even crypto, and then sell it later at a higher price, the profit you make is called a capital gain. It can be short-term, under 12 months, or long-term, over 12 months. And the difference matters a lot. According to the IRS, long-term capital gains in the US are taxed at preferential rates, either 0%, 15%, or 20%, depending on your taxable income. Compare that to earned income, which can be taxed at rates as high as 37%. In fact, the top marginal tax rate for regular income in the US is nearly double the top capital gains tax. In 2023, an individual earning over $578,125 was taxed at 37% on ordinary income, but only 20% on capital gains. This gap between how labor and asset growth are taxed is one of the biggest structural advantages for the wealthy. So now let's walk through a real-world example, okay? Say you buy $100,000 worth of stock in a private company or S&P 500 index. You hold it for 5 years. That investment grows to $180,000. You sell it and your capital gain is $80,000. If your income is under $492,300 for married filing jointly in 2023, you would likely pay just 15% on that gain, or $12,000 in tax. Now compare that to a freelancer or salaried worker earning $80,000. They'd pay around $13,000 to $17,000 in combined federal income and payroll taxes, depending on deductions. And they had to work full-time to earn that. That's the game, okay? One person works 40 hours a week, the other lets time and capital do the heavy lifting for them, and the tax code rewards the latter. And this doesn't even factor in capital losses, which investors can use to reduce their tax bill even further. If you sell one asset at a loss, you can offset that against gains elsewhere, a strategy called tax loss harvesting. So this makes capital gains income not only cheaper to earn, but also easier to shield. So how does that happen? Well, back in 1921, the US government had a bit of a problem. They wanted people to invest in businesses, build homes, and buy land. But the problem was, if people had to pay really high taxes every time their investments made money, they might not invest at all. So the government came up with a plan. If you buy something like a house or some company shares and it goes up in value, we'll let you pay less tax when you sell it. This kind of money you make is called a capital gain because it comes from your stuff growing in value, not just from working. Since then, this rule has mostly stayed in place. Investors and wealthy people really like it because they can make a lot of money without paying as much tax as regular workers. Over time, rich people figured out how to use this system to their advantage. Instead of taking a big salary, which gets taxed more, they would own companies or stocks, let them grow, and only pay the lower tax when they sold. And you're not just seeing this in the US either. Capital gains enjoy favorable treatment across most of the developed world. Take a look at the UK, for example. Capital gains are taxed separately at 10 to 20%, often lower than income tax. In Germany, if you hold an asset for over 1 year, you pay no tax at all. Australia offers a 50% discount on capital gains held over 12 months. Singapore doesn't tax capital gains at all. Compared to income tax rates in these countries, which can exceed 40%, capital growth almost always is rewarded more than labor. The idea was to encourage investment, but now it's kind of created a big gap between how labor and ownership are treated. So, if you work for your money, you are taxed more. If your money works for you, you're taxed less. You see, the world is changing, okay? More and more people who own things are making more money than people who work for a paycheck. And that is because the future of work will reward ownership, not just effort. In the past, most people earned money by working a job, right? But over the last few decades, that's changed. According to the US government, the share of money going to workers has gone down, while the share going to business owners has gone up. In 1970, workers got about 64% of the money the economy made. In 2023, they got less than 59%. That difference adds up to trillions of dollars. At the same time, investments have grown much faster than wages. Since 1990, the S&P 500 has grown over 1,600%, but average wages have only gone up around 18% after inflation. People who owned assets got way richer than people who just worked. Technology is speeding this up too. With AI and automation, companies can grow without hiring more people. This makes jobs less stable. Salaries grow slower, and some skills become useless faster than ever before. Earning money from a job depends on three things. First of all, that you can find work. Secondly, that your skills are still valuable. And third, you're healthy and able to keep going. But all of these are now harder to guarantee. A 2024 global survey showed that 1 in 4 workers worry their job will disappear within 5 years. AI tools are replacing office jobs, tech jobs, even creative work. Meanwhile, things you can own don't get tired, don't get sick, and they don't retire. They can make money for you every day, even while you sleep, and they can grow without needing more of your time. We're moving toward a world where people who own income-generating assets have more freedom and security than people who only work for money. A 2023 IRS report found that in households earning over $1 million a year, only 17% of that money came from salaries. The rest came from capital gains, dividends, businesses, and investments. The bottom line is this, okay? Jobs are important, okay? Absolutely they are. They help to get you started. But if you want long-term freedom, you have to build or buy things that make money without needing your time. The tax code rewards this too. Investments are taxed less than salaries in many countries, including the US. That is the future of work. Not more hours, not more hustle, but smarter ownership. Thanks for spending some time with us today, Alexa. We're so glad you did. I'll see you back here next time. Until then, take care.